Silver just dropped another $2.17 since Friday's close, $64.93 per ounce, on a day when no primary futures exchange is open, on a day when most investors are not watching their screens. Silver is falling through the floor and nobody is in the building. I am not going to tell you that does not matter. It does matter. A 46% decline from the January high of $121 in less than 2 months matters. That is real. That is painful. And if you are holding right now, you feel every dollar of it. But before you react to that number, I need you to understand something that will determine whether the next decision you make is the best or worst of this entire cycle. There are two types of crashes in commodity markets. One ends a bull market permanently. The other interrupts it violently and produces the most powerful rally in the history of the asset. The difference between those two types is not visible in the price. It is visible in the data underneath the price. And today I'm going to show you that data. I am Shadow Finance. If this breakdown helps you think clearly, subscribe and turn on notifications. Every vault update, every macro shift, every data point that matters will reach you directly. Type "still here" or "show me" in the comments. Let us get into it. Before I show you a single chart or a single price level, I want to give you one statistic. It is the most important supply number in the history of silver. It does not appear in any mainstream financial coverage of this sell-off. And once you understand it, the entire narrative around this crash changes. An estimated 95% of all the silver ever mined in the history of human civilization has already been industrially consumed and is unrecoverable. It is in landfills, it is in electronic waste, it is in thin layers across circuit boards, solar cells, and industrial coatings that cannot be economically extracted. It is gone, permanently. Now compare that to gold. An estimated 95% of all the gold ever found in the history of this planet is still here, in vaults, in central banks, around someone's neck. Gold accumulates across centuries. Silver disappears into the products that modern civilization requires to function. That is not two versions of the same trade. That is a structural supply reality unlike anything else in the commodity complex. And it is the single fact that separates what is happening right now from the crash that everyone keeps comparing it to. Every bearish argument I'm seeing in the comments and across financial media right now points to 1980. Silver ran from $6 to $50. Then it crashed and never came back. Therefore, silver at $65 after hitting $121 is the same pattern and you should sell immediately. 3 facts coming. 1980, silver flood hunt, burst. Speculation. COMEX intervention, $50 silver, plenty. Today, 95% consumed, no new mines. Shortage by 2032. Volcker's 20% rates. Commodity crash, 20% yield versus 0%. Capital fleas 38T, debt today, 7.6T. Interest, cost unsustainable, impossible. Volcker option, gone 47.6 seems. Oz, gone. 60% inventory, poof, physical demanded. And here's the detail that should stop you cold. When 60% of the registered inventory left those vaults in 4 days, the paper price of silver barely moved. The physical reality and the screen price were operating as two completely independent systems. That divergence is not a glitch. It is the structural fracture this entire thesis is built on. If the supply is constrained, the demand is institutional, and the Volcker option is dead, why is silver at $65? The answer is mechanical, not fundamental. This sell-off has the specific fingerprint of forced liquidation. Margin calls that require holders to sell regardless of their thesis. Oil near $170 per barrel, creating cascading liquidity pressure across all commodity markets simultaneously. A dollar surge that mechanically reprices every asset denominated against it. Forced liquidation does not care about supply deficits. It does not care about vault drain data. It sells what it needs to sell at whatever price clears the obligation. And when the selling is mechanical rather than fundamental, the price can go far below where the underlying economics would place it. That mechanical disconnection is precisely what creates the historic entry windows that produce the largest returns in commodity market history. Not because it feels like an opportunity. It does not feel like an opportunity. It feels like a disaster. That is the mechanism working as designed. The worse it feels, the fewer people hold. The fewer people hold, the more asymmetric the recovery. Between 1971, when Nixon severed the dollar from gold, and 1980, silver rose approximately 3,700%, from $1.65 to $50, in less than a decade. That move did not happen because of a single news event. It happened because the structural anchor holding silver prices down gave way, and the price reflected the accumulated physical reality that had been building underneath it for years. The anchor that ended that move was Volcker at 20%. That anchor is mathematically unavailable today. The structural supply deficit driving this cycle is more severe than the 1970s by every measurable metric. And the industrial demand from solar, electric vehicles, artificial intelligence, 5G, military applications, and nuclear systems did not exist in the 1970s. The mining sector currently represents approximately 1% of total global equity markets. During the 1970s commodity supercycle, mining stocks represented 12%. If the sector merely re-rates from 1% to 3% while nothing else changes, that alone represents a tripling of mining sector market capitalization. If it re-rates to 6%, still half of the 1970s level, that is a 6 times multiple. And these companies are producing silver at $12 to $50 per ounce against a current price of $65 with historically extraordinary margins. Silver at $64.93 on a Sunday evening is a number. The 95% consumption of all silver ever mined is a structure. The number changes every session. The structure changes on geological timescales measured in decades. The price changed. The facts did not. The supply is still constrained. The Volcker option is still dead. The December vault drain still happened. The industrial demand is still accelerating. The mining sector is still at 1% of global equities. New production is still 7 to 10 years away. Every major commodity supercycle in recorded history has included corrections of 30 to 40% on the way to its ultimate peak. The 1970s gold bull market that took gold from $35 to $850 included multiple declines of this magnitude. Each one felt like the end. Each one produced the same headlines. None of them were the end. And in the 1970s, the Fed still had the Volcker option available. Today, it does not. The mechanism interrupting this bull market is temporary by definition. The structural drivers are not. I'm not presenting this as certainty. I'm presenting it as a reading of publicly available data that anyone can verify. If oil escalation extends forced liquidation further, the selling may not be finished. If the Fed makes a surprise policy shift, the macro calculus changes. Those scenarios are real. Watching for them is analysis, not pessimism. But the base case supported by the data is clear. This is a mechanical interruption, not a structural ending, and the people positioned on the right side of that distinction will look back on $64.93, the way 2020 buyers look back on $12. I'm Shadow Finance. Every number in this video is verifiable from primary sources. The data says what the data says. Bottom or not yet. One word in the comments. Share this with someone watching the price right now who needs to see the data underneath it. I will see you in the next one.